Hello, everyone. During this session, we have the wonderful Julie Gordy, a longtime friend of Ceres and past member of our board of directors, as well as the Senior Vice President for Sustainable Investing at Impacts Asset Management, along with Ceres' own Billy Gridley, a director of the Ceres Investor Network. Together, they will explore what institutional investors can do to push financial regulators to act on climate as a systemic financial risk, and what investors can demand from federal agencies, such as the Department of Labor and the U.S. Securities and Exchange Commission. They'll discuss who can mandate climate risk disclosure and advance Paris-aligned portfolios, and what strategies investors can use to get more board oversight on systemic climate risk disclosure and disruption. Thank you. Over to you.
Hi, good day. I'm Billy Gridley from the Ceres Investor Network. I spent a couple of decades on Wall Street managing arbitrage portfolios. And then in 2005, I discovered climate risk. And I also discovered the externality of carbon pollution, which I think is probably the biggest market and policy failure of all time. We live in exciting times for climate policy. I work with investors on policy and climate action plans. And today we're going to discuss what investors can do to push regulators to protect investors and to manage systemic risk. Do investors have power? Sure, they have power. I'll give you a recent example. The DOL came out just March 10th and reversed two very bad rulemakings from 2020. And there was overwhelming investor opposition. And the DOL came out and said they would not enforce those rules. So it was a victory for shareholder rights, investor power, and rational markets, in my view, and probably also in the view of my guest today, Dr. Julie Gort from Impact Asset Management, who is a great leader of climate-aware, climate-ready portfolios out of London. They're headquartered, but they're global, and they've got about $40 billion in assets under management. Today, we're going to speak about financial regulators, and we're going to focus in on what we have and what we are and what we will be asking them for. So maybe, Julie, just for a minute or two, if you could introduce and kind of describe a little bit your life work and professional work, particularly, I mean, Julie, you were there back in 2010 when the SEC and Ceres and the SEC, we were arm in arm down there and interpreted guidance. That was the beginning. So Julie, I introduced Julie Gort and let her introduce herself personally.
Thanks, Philly. I was not only was I there in 2010 when they actually did the interpretive guidance, I was there in 2007 when we by Ceres and at that point PAX, which had yet to be acquired by Impacts, and several other investors petitioned the SEC to get that guidance. So, and I was also there in the US government in the EPA policy office when we were trying to negotiate the Kyoto Protocol, which was an exercise in running 10 billion models every day. So my role, Impacts has one mission. The one thing that we do with our investment is try to facilitate and hasten the transition to a sustainable economy. And what that means is, among other things, one that gets to essentially net zero emissions by mid-century, because we have to do that in order to avoid a global catastrophe, which we well know. So all of our investing is focused on getting to that sustainable economy and pushing it with the investment dollars that we have. My own particular role, I call it a dot connector. I try to connect up financial impact with sustainability measures. And rather than actually walking you through all 900 studies in my spreadsheet, I will just say that I have a spreadsheet that tracks about 900 studies that all link various aspects of sustainability to financial outcomes, both for companies and for funds. And you will be delighted to know that in 90% of the cases, the outcomes are positive and statistically valid in terms of the connections between sustainability and financial outcomes. That's me.
That's perfect, Julie. That's a good setup because investors crave certainty and we live in an uncertain world. and we try to get data from companies. We try to construct models. We try to understand what is going on in the world. And we need policies to help us understand the world. And so today we're going to talk about, in the main, two regulators. Now, by definition, it's an exciting time in the United States for financial regulatory development, not just because of the Biden administration, but because there are powers there which can be used. We're going to talk about two regulators in particular, the SEC and the Federal Reserve. So first, we're going to talk about the SEC, which is a bit more familiar ground for investors historically in terms of engaging the SEC or being on advisory committees or whatnot. The central mission, as I understand it, of the SEC is to protect investors. So do we have to ask them to protect us? Well, apparently we do. Their job is to maintain fair, orderly, efficient markets and to facilitate the formation of capital. That's their job. So we're asking them about doing their job. So Julie, investors have asked the SEC for several years to create and enforce climate disclosure rules. And actually they came out just recently with two major announcements, which were possibly encouraging. One about reviewing climate-related disclosures by companies, and the second about creating a climate ESG task force in the division of enforcement. Two announcements. What do they mean? Are the harbingers good here, Julie?
Yep. So the SEC has always been about disclosure, but up until pretty recently, most of that was disclosure of financial things that are already required disclosure in IFRS and US GAAP and things like that. So they could also penalize you if you didn't inform people of the risk of your investment or, tried to conceal information that investors would think was material. But their view of materiality was pretty much bounded by what we think of as financial reporting now. And for decades, that's exactly how investors did think about it. More and more, I would say in the last 2 decades in general, and the last half decade in particular, the investment world has really crossed the Rubicon to seeing things like climate change and biodiversity and diversity itself, human diversity, as being material to investment and to returns and factors that reasonable investors would want to know. But this is a departure. They're not required financial reporting, so it was kind of untrodden ground for the SEC. They didn't have a lot of expertise in it. They used to have an MOU, a memorandum of understanding with the EPA to help them out with that. I'm not sure if that ever helped them, but they never really seemed to do very much with it. So while they did create interpretive guidance in 2010 in response to our petition that did cover climate risks and climate opportunities, what they also said about it was, well, this is already required by Regulation SK. And if you suffer from insomnia, by all means, go read that. Several hundred pages of really riveting prose. But, while they said it was already required by Reg SK, they have never enforced it. So the fact that you were just talking about enforcement, that they have this task force in the division of enforcement that they've made announcements about enforcing existing disclosure rules is really important, because we all know that from the announcement that we just got today, actually from March 10th, from DOL saying we last year the DOL promulgated 2 really awful rules, and we're not going to enforce those. So as we all know, enforcement is really the key to making any regulation meaningful. So it's really good that the SEC has announced this and that they seem to be moving down that path. The other place besides enforcement, where they could really make it, sort of seems as though they're having a senior advisor for climate, which they do now for the first time ever, could really be helpful. The last 2 years, the SEC has been getting tougher and tougher and stricter about shareholder proposals, especially on ESG issues, especially on climate. And they were using these very strange and very opaque criteria to exclude shareholder resolutions on things like climate change, like micromanagement. Yes, if you save the planet, you're micromanaging the company. You can't do that. So I think that will change too. And that's not so much of an enforcement issue, but it's still an internal SEC issue.
Thanks. So just sort of dipping back in time here. So 2010, but between 2010 and 2021, really from the SEC, little to no enforcement.
Right.
Well, rules don't work unless you enforce them, I guess. So, and I think maybe the wins, at least of the administration, a whole of government, a whole of society approach to climate. But we don't yet really know about the enforcement side yet. So early days.
Yeah, early days, but encouraging days. I mean, you talked about these days being really exciting now at the SEC. They were exciting in the last 4 years too, but exciting in the sort of harrowing, like, oh God, what are they going to do now?
Right.
Now it's exciting as in exhilarating, like we might actually be able to make some progress.
Right. Great. So that's SEC and, a bit familiar ground for investors in terms of engaging. New or recent is the Fed, and the developments around the world in climate, whether it's a storm or a fire or any of the data, and the data just relentlessly shows what the scientific models of scientists have said. The Fed, like their brethren across the ocean, are thinking about climate risk, and even in the last year, the Fed has started, even during the Trump administration. So, primary mission SEC, protect investors. Primary mission of the Fed, I just wrote down, is to protect people. But of course, and people by protecting the economy. I'm going to dumb it down to 3 little S's: safety, soundness, and stability of the financial system, and 1 big S, systemic risk. So they're protecting the system, the economy, the financial system, therefore people. And many have concluded climate risk is investment risk, is financial risk, is systemic risk. There's just a big equation there. So here's my question. I set the table, and here's the question. Ceres and various allies and others have called on the Fed to move quickly to incorporate climate risk into their bank supervision activities, into scenario analysis and stress testing. But some of the various regulators, including the Fed, have raised concerns about data and modeling, uncertainty, and that they say that may slow their ability to address climate risk in supervision. What do you say to that?
So newsflash, I mean, everything in investing is about skating to where the puck is going to be. None of it is backward looking, right? So whenever we're trying to do things that, like the stress testing that banks are required to do now, it's not about the past, it's about the future. How resilient are you going to be if we have another financial downturn? And unless the Fed has some kind of economic and financial crystal ball that they've never mentioned to anybody, they're still making predictions. So using the use of climate modeling as far as, stress testing for climate scenarios is by no means an unfamiliar exercise. It's just that the financial institutions have to use climate models, which they're not familiar with. But we have a lot of history in climate modeling, and the modeling that we have now, which are called CMIP 5, and we're now moving into the CMIP 6 area. And in case CMIP is speaking tongues to you, that stands for Coupled Model Intercomparison Project, which I'm sure makes it completely crystal clear to everybody. But basically what those things do at both the sort of regional and global level is predict various pieces of the global climate puzzle. So some of them concentrate just on precipitation or atmospheric volatility or ice or sea level rise. I mean, they all have sort of a different stone to bring to the edifice, but that modeling system is what gives us the projections that we hear every year from the IPCC. Here's what's going to happen. We're moving towards 5 degrees. We need to stay below 2 in order to avoid a climate catastrophe. So it's that modeling that we rely on. And while those are, they are projections about what's going to happen in the future. Projections are almost, I'm an economist, I'm speaking from experience. The only question about any prediction is, yeah, how far off you're going to be and in which direction, right? But those models have actually proven to be very accurate. When we look at what predictions were made 20 years ago about what would happen 10 years ago, they are astonishingly accurate. So that the only thing we also know, though, about the accuracy of those models is that they are in general quite conservative. So if you want to know what the best case outcome is, they will tell you. The worst cases don't so much get modeled. A lot of that is just because there are all kinds of factors that make them that way. But it's kind of, if you want to know what the future of the climate looks like, look at the IPCC projections, what's coming out of the climate models, and then assume that that's as good as it's going to be. It could possibly be worse.
So education learning curve at the Fed, interesting. 2005, I retired from Wall Street career and I discovered climate change. I told you that. And what I did was I went to school immediately to Columbia University, the home of the Lamont Doherty Earth Observatory, and studied the science. And so I guess we could help accelerate their learning. Investors might be able to help, or industry, or I'm not quite sure. But so, they know there's a problem, but, they also are doing things day to day. I mean, in the quantitative easing recently, which was related to the stimulus, the Fed had asset purchase programs, just like they did back in the 2009-8 days. And so here's my question, could those asset purchases be creating climate risk in the assets that they purchase and the companies and sectors they're supporting? What should the Fed be doing today?
Yeah.
And what should they not be doing, Julie?
Super question, Billy. So QE, or quantitative easing, is what central banks do when their sort of normal tool for economic stimulus, which is manipulation of the interest rates, doesn't have any more arrows in the quiver, right? And we're now at practically zero in terms of interest rates. You can't lower interest rates very much more and get much economic stimulus out of it. So QE is what you do if that isn't working, or if you want to speed it up a little bit. So we did that, as you said, during the Great Recession. Now, the way they do that is in a way that they call market neutral, but the market in question is not the market or the financial market that we understand. It's the bond market. And a lot of that is really heavily tilted towards big emitters. The Grantham Institute did a report about this a couple years ago, and they showed that in the EU, the European Central Bank, their asset purchase programs were 62.1% of the corporate bond purchases take place in manufacturing, electricity, and gas, which are responsible, just those, for 58.5% of Eurozone greenhouse gas emissions. And of the, so there, in the UK alone, more than 10% of the QE purchases were oil and gas alone. So what that means is essentially, and that's a whole lot bigger than their share of the economy. If you look at the S&P 500 right now, energy is around 2% of it, right? So I would imagine our own bond markets, if I look at the junk bond indexes and the sort of high yield indexes, there's a lot of oil and gas, a lot of fracking. Those are probably pretty heavily stacked towards oil and gas. Now, a lot of those firms might actually be zombies. And by zombies, I mean companies whose earnings are not sufficient to cover their debt repayment. So that would be a really, let me understate the case massively by saying poor kind of investment for the Fed to make if what they want to do is create economic stimulus. Keeping zombies afloat is not the same thing as stimulating the economy. There have been suggestions for green QE that would be where there would be a tilt towards purchases of greener and more energy efficient securities in the bond markets for the Fed. I'm not sure if any of them has actually made the leap there yet, but a lot of central banks are talking about it. So I think this is an idea that they should be considering, especially if they're interested in stabilizing the economy, as opposed to just stabilizing a few companies in the economy.
So let me just think about this here. We've talked about the SEC, we've talked about the Fed, and to relate the two, if the SEC had mandatory or stricter climate risk disclosure, the Fed themselves would be a better risk manager in the quantitative easing program.
Maybe. Disclosure doesn't necessarily manage risk,
Okay.
right?
Yeah.
So the SEC can get companies to disclose more about climate risk, but it can't make them actually act on those risks. So the Fed is charged with protecting the health of the economy. That's what systemic risks means. And that can never be measured at the company by company level. So the SEC can help build the infrastructure for a more sustainable economy by requiring that disclosure. And that would be really helpful, because the more investors know about those risks and opportunities, the better they can direct the flows of capital towards solutions to the climate crisis. Does that make sense?
That absolutely. Yeah,
Cool. Can I just turn the tables on you now, Billy, and ask a question of you?
sure.
Is that okay?
Yeah, go ahead.
Or did you want to do something else?
No. That's okay. Go ahead.
Okay. So you, as you said early on, you've been a Wall Street investor and board and investment committee advisor for a long time, and now you're a policy advocate and an organizer on behalf of investors. So, and I know the Ceres Accelerator report came out, I think last year, and I thought that thing was absolutely fantastic. So what is the Ceres Accelerator working on to push regulators now to develop better price signals and clear investment pathways to net zero and the transition to a more sustainable economy?
Right. So price signals, data, transition pathways. We need more information, and in fact, I think we need more policy. So at Ceres, we have a rich ecosystem, investor network, company network, and policy network. And recently, for strategic reasons, we put on top of these networks and our programs the Ceres Accelerator. And one of the main strategic thrusts is financial regulators. And I think, although I'm not an expert in the area by any stretch, investors have more so, usually it's been, SEC and DOL engaging those. Well, now in the Ceres regulator, and you read that regulator report, now we're going across, and there's an alphabet soup of regulators out there. So we're now expanded our policy advocacy activities to the SEC, the Fed, FSOC, Financial Stability Oversight Council, FDIC, most people know that, CFPB, you have to kind of know the acronym, Consumer Financial Protection Bureau, the OCC, the CFTC, Commodity Futures Trading Corporation, and even housing and physical risks, or FHSA. So now we're across this. There are more than we can possibly work on, but it's really 8, 9 main federal regulators, and then 50 states. Each one has a banking regulator. Each one has an insurance regulator. So 2 times 50 equals 100. So 100 plus 8 is 108. We're now engaging that many regulators, and so that keeps us pretty darn busy. And one of the questions I'm asking myself is, are we going to engage these regulators in a different way? They're maybe not used to being engaged the same way. So, for example, and you may have participated in this in the past. Have you ever been involved in the SEC advisory committee, or folks involved in that, right?
Yeah.
But I don't, and I think in the CFTC case, they did just do their quite seminal study last year. Our CEO, Mindy Luber, was part of the, I'm not quite sure the name of the body, advisory body, which was chaired by Bob Litterman, who's on on the board of Ceres now, and an ex Goldman Sachs colleague of mine. But so we're going to have a bigger breadth of regulators, Fed and state, and of course, good news. Fed announced its intention to join another alphabet name, NGFS, the National Greening
Network for Greening the
Financial
Financial
System. Didn't quite get it. Sorry.
Network for Greening the Financial System.
Thank you. I appreciate it very much. So that's what we're doing, and we're 9 months into it, and we are talking with regulators every day on the phone. And some of them say, "Yep, I get it," and some of them say, "We need to learn more." And so that's where we are in the state of development here in the United States. And I'm also, often very jealous. And I told your colleagues in London this last week. I'm a little bit jealous. The Europeans, they're years ahead of us on this, and we've got to catch up in order to maintain economic and financial leadership in the United States. And that's my view. So,
but I was reminded by a friend of mine last week that there's this old French proverb or saying that says you can put the church back in the center of the village. There is a global village of regulators, there's a national village of regulators, and we're putting the climate change church right in the middle of them again. Bless you, Ceres. This is the work that has to be done, and I commend you for it.
Well, I appreciate. So from our session, just to do a little wrap up here and maybe takeaways, from your comments on SEC and Fed and your sort of worldview, did you kind of have some takeaways to wrap up this session?
So I think that when you describe the breadth of regulators that you covered and that you're working with after the publication of the accelerator and the work that we've done with DOL and other agencies on all this, I think there is no silver bullet. So there's no single solution. Climate is going to have to be addressed by national governments, by international bodies and regulators, by investors, by citizens, by companies, by towns, by states, by provinces. It is absolutely everybody's job. And there's always some piece that anyone can contribute. And so I think, when you think about this, yes, it's an alphabet soup, it's a little overwhelming, but I think the idea is, you do what makes sense and you try to move the needle where you can. And if everybody does that, we'll solve this thing.
Perfect. So putting together a mosaic, three-dimensional mosaic, a global
mosaic theory. Yes.
Okay. Well, great. Well, I appreciate very much. So, the other thing is, we did call this session, we said, how can investors push regulators? And there's just a whole variety of ways. We do, obviously, we do sign-on letters. We create letters, we write letters, we share them with investors. We ask them to submit them directly to regulators. The DOL in other cases prove that when regulators hear directly from investors, they're like, whoa, okay, now I'm listening to that. We also do private engagements, small group engagements with a commissioner or a chair of any of these agencies. We do bigger events. We've run these events. We're running one again in May. We call them LEAD events. They're Lawmaker Education and Advocacy Days. And well, we did it virtually, of course, last year, and it'll be virtual this year. But where we get a bunch of people in a Zoom room, and we get either the legislator or the regulator on the other end, and we talk. We ask questions, we chat, we do all that. And then there's finally thought pieces, blogs, webinars. Of course, your firm, Impacts, and Ian Sim are great thought leaders in sustainability and resilience. So Julie, thank you. I've enjoyed speaking with you today, and I hope that our Ceres 2021 audience also benefits from our talk. And we'll come back. We'll give you another update. I don't know when, but we'll do it. So thank you so much for listening, and thank you for participating today, Julie.